If you're looking for a safe way to grow your money with zero risk, you've probably heard about GICs, but what exactly are they and how do they work? Hi, I'm Rainer, and today we're breaking down everything you need to know about guaranteed investment certificates in Canada. So what exactly is a GIC? GIC stands for Guaranteed Investment Certificate. It's one of the safest investment options available in Canada. Here's how it works. You give a bank or financial institution a lump sum of money for a specific period of time, and in return, they guarantee to pay you a fixed interest rate. At the end of the term, you get your original money back plus the interest you've earned. The key word here is guaranteed. Unlike stocks or mutual funds that can go up or down, with a GIC you know exactly how much you'll earn. There's no risk of losing your principal investment. GICs are also protected by deposit insurance. If you buy a GIC from a bank or credit union that's a member of CDIC, the Canada Deposit Insurance Corporation, your investment is insured up to $100,000 per account category. This means even if the bank fails, your money is protected. How do GIC terms work? GICs come in different term lengths, typically ranging from 30 days all the way up to 10 years. The most common terms are 1 year, 2 years, 3 years, and 5 years. Generally, the longer you commit your money, the higher the interest rate you'll receive. For example, a 1-year GIC might pay 3.5%, while a 5-year GIC might pay 4.3%. These rates change based on market conditions, so it's important to shop around when you're ready to invest. There are different types of GICs you should know about. A traditional or non-redeemable GIC locks your money in for the full term. You cannot access it early without penalties, and in many cases you simply can't withdraw at all until maturity. The benefit is these typically offer the highest interest rates. A cashable or redeemable GIC gives you the option to withdraw your money before the term ends, usually after a minimum period like 30 or 90 days. The trade-off is you'll receive a lower interest rate compared to a non-redeemable GIC. There are also market-linked or equity-linked GICs where your return is tied to stock market performance. Your principal is still guaranteed, but your interest rate varies based on how the market performs. These are more complex and usually offer lower guaranteed minimums. What are current GIC rates? GIC rates change frequently based on the Bank of Canada's interest rate decisions and overall economic conditions. As of early 2025, you can find 1-year GICs ranging from around 3.5 to 4.5% and 5-year GICs in the 4 to 5% range. However, these rates fluctuate, so always check current rates at multiple banks and credit unions before investing. Online banks and credit unions often offer higher rates than traditional big banks, so it's worth comparing options. Where do GICs fit in your savings strategy? GICs are excellent for money you know you won't need for a specific period of time. They're ideal for your emergency fund once it's fully built, for short-term goals like saving for a down payment in 2 or 3 years, or for the conservative portion of your investment portfolio, especially as you get closer to retirement. Many people use a GIC ladder strategy. This means you split your money across GICs with different maturity dates, maybe one maturing each year for 5 years. This gives you regular access to portions of your money while still earning the higher rates of longer-term GICs. Here's something important. You can hold GICs inside your TFSA or RRSP. This is powerful because you get the guaranteed return of a GIC plus the tax advantages of these registered accounts. If you hold a GIC in a regular non-registered account, you'll pay tax on the interest you earn each year at your marginal tax rate. But if you hold that same GIC inside a TFSA, all the interest is completely tax-free. Inside an RRSP, the interest grows tax-deferred until you withdraw in retirement. What are the downsides of GICs? The main disadvantage is lower returns compared to long-term stock market investments. Historically, stocks have outperformed GICs over long periods, but they come with much more risk and volatility. Another downside is inflation risk. If you lock in a 3% GIC and inflation runs at 4%, you're actually losing purchasing power even though you're earning interest. And with non-redeemable GICs, your money is locked in. If interest rates rise significantly after you've locked in, you can't access your money to take advantage of the better rates without waiting for your term to end. So to recap, GICs are safe, guaranteed investments perfect for money you don't need immediate access to. They offer predictable returns, are insured by CDIC, and can be held inside TFSAs and RRSPs for tax advantages. As always, this is educational content only, not financial advice. Your personal situation and goals should guide your investment decisions. If you found this helpful, check out my videos on TFSAs and RRSPs to learn more about where you can hold your GICs for maximum tax efficiency. Thanks for watching.